Welcome to the Stock Market Palantir. Today, we are going to talk about WKHS, Workhorse Group Inc., is currently navigating what management itself has called a strategic inflection point in late 2025. And to be clear, this isn't about speculative growth anymore. It's about severe financial distress and a profound liquidity crisis that places the entire enterprise at risk.
That observation is absolutely critical. I mean, the stakes are undeniably existential for legacy shareholders. The central issue before the company, and really the core of our analysis today, is this proposed merger with Motive Power Systems. Management has labeled the transaction a make-or-break event, and, we have to treat that language as an unambiguous declaration of crisis.
Precisely. So the core tension isn't whether this deal is, favorable in a vacuum, but whether it is necessary. Does the Motive merger provide the combined entity with the operational structure and the financial runway it needs to actually achieve long-term viability? Or is it, as the skeptics maintain, just a desperate defensive consolidation that guarantees massive dilution while introducing critical and frankly unacceptable legal and financial liabilities?
See, I come at it from a different perspective. I'd argue that while the deal might be a necessity for the company as an entity, its structure suggests it primarily facilitates a recapitalization for Motive's existing investors and creditors. In doing that, it saddles the remaining public company with such extreme risks that it mathematically guarantees the severe erosion of legacy shareholder value.
I see why you'd think that, especially if you're focusing purely on the punitive financial mechanics. But let me offer a different framing. I believe this merger is, undeniably, a vital call option on survival. It is, practically speaking, the only mechanism left for Workhorse to preserve any remaining equity value. The dilution is agonizing, yes, I completely agree, but it's a necessary cost to secure the liquidity needed to extend that operational runway past the immediate horizon.
But what fundamentally are they buying with this massive value-destructive dilution?
They're acquiring a comprehensive, tested business model and, established market credibility. The whole strategic rationale centers on creating a legitimate category leader in the medium-duty EV market, so Class 4 through Class 6. Workhorse contributes its underutilized physical assets, specifically the manufacturing footprint at the Union City plant and its national dealer network. Motive, however, provides the core value, proven technology through their Epic 4 platform, established fleet relationships, and a key metric: they have logged over 1 million real-world electric miles.
That 1 million miles logged, it's a great talking point. But was it achieved under sustainable unit economics? I mean, the mileage itself doesn't guarantee future profitability.
But that established operating history significantly de-risks the integration. Motive's technology is known to operate reliably. And look, we have to consider the alternative here. Failure to ratify this merger in late November will, as management notes, likely force Workhorse into a standalone path. And that path is just fraught with immediate restructuring risks, which could obliterate the remaining equity value entirely through bankruptcy proceedings.
I respect the urgency, I really do, and the goal of de-risking the tech stack. But the financial reality of this distressed transaction cannot be ignored. The cost is simply overwhelming, and the resulting cash position remains critically fragile. Let's just detail the ownership transformation for a second. Legacy Workhorse shareholders will be diluted to a minority stake of approximately 26.5%, a stunning collapse. Motive's controlling investors assume majority control at about 62.5%, and crucially, another 11% is allocated directly to the senior secured lender. That just shows this is a debt holder-dictated recapitalization.
It's expensive capital, undoubtedly. But in this kind of distressed environment, the fact that the capital is available is really the only thing that matters. They are buying time.
But how much time? We have to look at the critically low unrestricted cash position of only $12.7 million as of the end of Q3. For an automotive OEM trying to integrate a new technology stack and scale up production, $12.7 million is, it's an insufficient runway. The very fact they had to execute a $20 million sale-leaseback of their facility was a desperate measure just to scrape that bridge financing together. This action screams fragility.
That's one interpretation. I would frame it differently. Management acted decisively to monetize a hard asset to secure necessary liquidity in a hostile environment. But let's move past the immediate cash position and address the severity of the capital structure reset itself.
I'm not convinced, because this is not the first or even the second painful capital reset we've seen. We need to acknowledge the severity of the cumulative 1-for-250 reverse stock split. This was done over two punishing actions, a 1-for-20 split in June 2024, then a 1-for-12.5 split in March 2025. When you crunch those numbers, an investor who held 1,000 shares less than 2 years ago now holds just 4 shares.
It's devastating. I agree.
But the implications are worse than just optics. This drastic reduction in share count signifies persistent structural distress. Worse, it creates a psychological and operational nightmare. Post-split microcap stocks are aggressively targeted by short sellers and specialized algorithms. The splits themselves just feed a negative feedback loop, leading to rapid price decay because algorithms view such actions as confirmation of fundamental failure.
I fully acknowledge the immense pain and the negative market perception caused by the splits. It was brutal for long-term holders. However, we have to frame those splits as an unfortunate but unavoidable necessity to maintain NASDAQ listing compliance. Losing that compliance would force the stock onto the OTC markets, which would entirely destroy access to public capital, the very capital needed to fund this merger. It was the only fiduciary path available to keep that door open.
An open door to more dilution, perhaps?
Perhaps, but let's look at the institutional view. We shouldn't overlook a crucial governance victory here. Leading proxy advisory firms, ISS and Glass Lewis, both recommended that shareholders vote for the merger. While retail investors are focused on historical grievance, these firms analyze fiduciary duty and strategic viability. Their endorsement shows institutional approval of the direction, indicating that sophisticated fiduciaries believe this is the best path forward, despite the dilution.
I respect their opinion, but institutions often have drastically different entry points and objectives than the retail base. An institutional investor buying in at, say, 5 cents post-split has a different risk profile than a retail holder who saw their 1,000 shares turn into 4. My focus remains on the operational stability versus the potentially catastrophic inherited risk.
On operational stability, we have tangible evidence of improvement. Workhorse reported a significant reduction in net loss, improving from $25.1 million in Q3 2024 down to $7.8 million in Q3 2025. This move toward break-even, coupled with the merger, is designed to generate sustainable profitability. Merging with Motive, which brings Ford EQVM-approved and CARB-certified technology, allows them to internalize that manufacturing at Union City.
Hold on, we need to pause right there. You cite Motive's technology as a benefit, but we should define those terms. CARB certification means the tech meets California's stringent emission standards, which is vital.
And the Ford EQVM approval is perhaps even more crucial. It means the technology has met Ford's rigorous, OEM-grade standards for quality and reliability. That approval lends massive credibility to the Motive platform, something Workhorse desperately lacked. Internalizing production of that approved technology is the only path to improving gross margins.
I'm sorry, but I just don't buy that net loss improvement is evidence of core operational success. Let me tell you exactly why that $7.8 million Q3 loss is misleading. If you perform a granular analysis of the income statement, you find that reduction was materially aided by two distinct one-time non-operating gains.
Which were?
First, a $4.8 million gain from deferred revenue recognition. This is not fresh operating cash. It's the accounting recognition of cash paid long ago. Second, there was a massive $13.8 million gain stemming directly from that $20 million sale leaseback we talked about. That's not profit from selling trucks. It's a financial gain from disposing of a core asset. Without those non-recurring items, which total nearly $18.6 million, the core business remains deeply and structurally unprofitable. It feels like financial engineering ahead of the merger vote.
Financial engineering is often a necessity when capital markets are closed. And while those gains may not reflect current unit economics, they show management's ability to maximize leverage to stay in the game. Furthermore, Let's credit Motive with a major legal victory. They secured a significant win in September at the ITC, where a judge ruled that Motive did not infringe on any valid Samsara patents. That removes a critical barrier.
That's a compelling argument, but have you considered the ongoing, far more dangerous risk? The ITC ruling was limited strictly to patent infringement. The federal lawsuit by Samsara in Delaware, covering severe claims of fraud, trade secret theft, and unfair competition, that remains active. This is not a technical patent dispute. This targets the very integrity of the underlying business.
But what is the practical liability?
If Samsara prevails on those claims, especially trade secret theft, it poses a massive potential financial liability, potentially into 9 figures. Damages like that would immediately drain the combined company's already fragile $12.7 million in cash, forcing an immediate bankruptcy. This legal overhang is not a footnote. It's a ticking time bomb that Workhorse shareholders are implicitly agreeing to inherit.
We both agree the legal situation demands monitoring, but let's shift to the trading environment, something that has shaped retail behavior.
Indeed. And WKHS stock exhibits the classic hallmarks of a distressed microcap equity. We see this specifically in the trading microstructure. The data shows the off-exchange short volume ratio often exceeds 70%, reaching a high of 77.09% on November 7th.
And for the audience, we should probably explain the significance of that ratio.
Right. This high ratio is primarily due to wholesale market maker internalization of retail orders. So when large market makers execute retail buy orders internally, they often pair them with short sales instead of routing them to a public exchange. This internalization process means those retail buy orders never really hit the lit market. Theoretically, this dynamic prevents true price discovery and can act as a consistent dampener on any upward momentum.
And I acknowledge that retail sentiment has certainly shifted dramatically, moving from that euphoric optimism of the meme stock phase to what is now essentially capitulation. The goal for many remaining shareholders is simply avoiding a total loss of capital, which drives them toward accepting this merger.
Yet, despite the widespread belief that this is building pressure for a massive short squeeze, the official data tells a very different story.
Exactly. The official short interest, as reported, is modest at only 6.77% of the float. And critically, the days to cover is extremely low, at only 0.35 days. This metric suggests short sellers face virtually no risk. They can exit their positions rapidly without triggering a price spike. This data point entirely undermines that retail narrative that a squeeze is imminent.
So the market structure ensures that even if they are successful, the retail investor's ability to benefit from true price discovery is curtailed, and the perceived short pressure is a misunderstanding of the actual risk.
That analysis is correct. The majority of shareholders appear to be voting for the merger because despite the staggering dilution, it's their only pragmatic path to retaining any option value on their investment, acknowledging the binary risk of total failure otherwise.
Pragmatism, perhaps, but at the cost of being reduced to a marginal, heavily diluted minority shareholder and a highly leveraged, legally exposed new entity.
As we conclude, I would reiterate that the merger, despite its tremendous costs, remains the strategic solution required to overcome these immediate liquidity and manufacturing hurdles. It creates a legitimate platform that can leverage Motive's tested, certified technology and achieve the scale necessary to compete. It's a necessary, albeit painful, pivot toward future viability.
And I maintain that the new Workhorse is essentially a public listing vehicle for Motive, financed by the obliteration of legacy equity and burdened by legacy debt, compliance issues, and that high-stakes Samsara litigation. When you factor in the cumulative 1-for-250 reverse split and the massive post-merger dilution, the long-term recovery of previous price highs is for all intents and purposes mathematically improbable.
We certainly agree that the situation is highly binary. And the decision for shareholders demands deep scrutiny of all financial and legal factors, weighing the critical necessity of corporate survival against the cost of extreme dilution and the acceptance of significant inherited risk.
The complexity requires rigorous due diligence, and the outcome remains far from guaranteed, regardless of the shareholder vote.
We've analyzed the financial distress, the cumulative dilution, and the critical strategic and legal risks inherent in the proposed Motive merger for Workhorse Group, Inc.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights. And see you in the next video.